What if the greatest investor of our time started his journey not in the halls of Wall Street, but with a boy delivering newspapers on a bicycle through quiet suburban streets? Warren Buffett, long before he became known as the Oracle of Omaha, was just a curious, determined kid growing up in the American Midwest. Born in 1930 during the early days of the Great Depression, Warren Edward Buffett entered a world marked by economic hardship, uncertainty, and dramatic change. His hometown of Omaha, Nebraska, was far from the centers of finance and industry. But even at a young age, Warren showed signs that he thought differently than the children around him. While other kids played games in the street or collected baseball cards, Warren was more interested in numbers. He read every book he could find on investing, money, and business from the local library, some more than once. He had an extraordinary memory and a deep curiosity that pulled him toward learning how things worked, especially the world of finance. By the time he was 7 years old, he had already decided that he wanted to be rich, not because he was greedy, but because he was fascinated by the power of compound growth and smart decision-making. Unlike many kids, Warren understood early that wealth wasn't just about earning money. It was about keeping it, growing it, and using it wisely. His father, Howard Buffett, played a significant role in shaping Warren's thinking. Howard was a stockbroker and later a member of the U.S. Congress, and he kept a small office in downtown Omaha where Warren would often visit. There, Warren would sit quietly and watch the ticker tape machines report prices from the New York Stock Exchange. It was like another language to most people, but Warren was determined to understand it. He began collecting bottle caps, counting coins, and looking for patterns in the behavior of local businesses. Even before he was a teenager, Warren wasn't just playing games. He was experimenting with business. He sold packs of chewing gum door to door. He moved on to selling Coca-Cola bottles and weekly magazines. Not long after, he bought a used pinball machine and convinced a local barber to let him install it in the shop. Soon, the machine was making money. Instead of spending it, Warren used the profits to buy more machines, placing them in other barbershops around town. Within a few months, the small operation turned into a handful of locations and regular income. Eventually, he sold the entire business for over $1,000, a small fortune for a boy still in high school. It wasn't just luck. It was the result of observing, calculating, and acting with discipline. Warren was also a keen observer of people. He noticed who spent money and why. He asked questions like, what do people always need? And what kinds of businesses keep growing even when the economy slows down? At the age of 11, Warren made his first stock purchase. He bought 3 shares of Cities Service Preferred, a company in the oil industry. The stock fell shortly after he bought it, and Warren felt the pressure. But instead of selling in a panic, he waited. Eventually, the stock recovered slightly, and he sold it for a small profit. Later, the stock rose dramatically in value. That early experience taught him a powerful lesson. Patience often brings bigger rewards. From that moment on, he began to think not like a child hoping for quick wins, but like a long-term investor looking for steady, reliable growth. As he grew older, Warren continued to explore business ideas. He delivered newspapers for the Washington Post, waking up before dawn to ride his bike through the neighborhoods of Omaha. It was hard work, especially in the cold winters, but Warren saw every paper route as an opportunity. He calculated exactly how many houses he needed to cover to make a certain amount each week. He tracked his earnings in ledgers and began saving aggressively. By the time he was in high school, Warren had saved several $1,000s. He used some of it to invest in farmland. Owning land, he realized, meant collecting income without working every day. This was another early lesson in passive income, earning while you sleep. Warren also bought a used car and rented it out to other students who didn't have one. Every decision he made seemed to reflect a deeper understanding of value. He wasn't chasing trends or trying to impress anyone. He was building a foundation. While many teenagers spent their money on clothes or entertainment, Warren reinvested nearly every dollar he earned. He was fascinated by the idea that money could grow by itself over time if used wisely. Compound interest, to Warren, wasn't just a mathematical concept. It was a strategy for life. He once said that he read about compound interest when he was very young and instantly recognized it as one of the most powerful forces in the world. This mindset set him apart. In high school, Warren already had the habits of a disciplined investor. He read constantly, asked thoughtful questions, and learned not just from books, but from people who had real experience in business. He wasn't afraid to knock on doors, ask for advice, or take small risks. He viewed failure not as something to avoid, but as something to learn from. Every small mistake taught him something valuable. He didn't need instant success to feel confident. He needed progress. By the time he applied to college, Warren had a strong understanding of business fundamentals and a clear sense of what he wanted to do with his life. He enrolled at the Wharton School at the University of Pennsylvania, but later transferred to the University of Nebraska to finish his degree. Even during college, he continued running small businesses and studying the stock market. He read hundreds of books, many of them multiple times. He wasn't just reading for fun. He was studying the habits of successful people and looking for patterns. One of the most important things about Warren Buffett's early life is that it wasn't about being born into money or privilege. It was about how he used his time, his energy, and his curiosity. He didn't wait for the perfect opportunity. He created his own, and he did it by staying focused, being patient, and always thinking long-term. Warren Buffett's journey from a paperboy to a budding investor was no accident. It was the result of years of practice, study, and persistence. Every early job, every business idea, and every dollar he saved built the habits that would one day help him manage billions. But even then, he was still just beginning. How do you go from being a curious young investor to learning from the very people who wrote the rules of the financial world? For Warren Buffett, the journey of refinement and wisdom began not in Omaha, but in the lecture halls and libraries of New York City. After completing his undergraduate studies, Warren applied to Harvard Business School, certain it was the next step for him. But to his surprise, he was rejected. It was a rare moment of disappointment in a life filled with forward motion. However, rejection often points the way to unexpected opportunities, and in Warren's case, it led him somewhere even better. While reading an updated edition of The Intelligent Investor, a book he had already studied many times, Warren noticed something he hadn't before. The author, Benjamin Graham, was a professor at Columbia Business School. This was the same Benjamin Graham considered the father of value investing, the man who transformed investing from gambling into an intelligent, methodical discipline. Warren applied to Columbia and was accepted. For him, this wasn't just education, it was a chance to study under his hero. Benjamin Graham wasn't just a professor. He was a practicing investor and co-author of the Graham-Newman Partnership, one of the most respected investment firms of its time. His approach to investing was clear, logical, and deeply disciplined. He taught his students to think of stocks not as lottery tickets, but as pieces of real businesses. He emphasized margin of safety, which meant buying stocks for less than their intrinsic value, so even if things didn't go perfectly, the risk was minimal. To Warren, this approach was like discovering a map after years of wandering. It aligned perfectly with how he already thought. He devoured Graham's teachings, took extensive notes, and absorbed every lesson with laser-like focus. Unlike many students who viewed classes as a path to a degree, Warren saw them as tools for transformation. He often said that Graham changed his life not by telling him what to think, but by showing him how to think. Warren was one of the top students in the program, and after graduating, he wanted nothing more than to work at Graham-Newman. He wrote letters, made phone calls, and even offered to work for free. But initially, Graham said no. The firm wasn't hiring. Warren returned to Omaha and worked at his father's brokerage firm, yet he never gave up hope. He continued investing on his own, applying everything he had learned. Eventually, Graham relented and offered Warren a position at the firm. It was a defining moment. At Graham-Newman, Warren wasn't just learning theory. He was seeing it applied on real portfolios with real stakes. He studied financial statements, analyzed companies, and watched how Graham handled both success and failure. He saw the importance of patience, of discipline, and of not letting emotion drive decisions. Graham was cautious and conservative, always looking for hidden value and avoiding unnecessary risk. He avoided hot stocks and flashy trends, choosing instead to focus on solid fundamentals. Warren respected this immensely. But as time passed, he began to feel a subtle tension between Graham's strict formulas and the way Warren himself was beginning to see the world. He began to realize that some businesses weren't just undervalued stocks, they were powerful machines for growth. He started thinking not just about price, but about quality. This was the beginning of Warren's evolution as an investor. He would later blend Graham's principles with his own insights, thanks in large part to a friendship that was soon to change everything, his relationship with Charlie Munger. But at that time, working under Graham gave Warren a foundation of logic and caution. He learned that success in investing came from avoiding big mistakes as much as making brilliant moves. He also began to understand that temperament matters more than intelligence. You don't need to be a genius to succeed in the stock market. You just need to keep your emotions in check and stick to your principles. After a few years at Graham Newman, the firm dissolved. Graham retired and Warren had to make a choice: stay in New York or return to Omaha and build something on his own. He chose Omaha. Most people thought it was strange. Why would a promising young investor leave the center of finance? But Warren believed that being away from the noise of Wall Street would help him stay focused. In Omaha, he could think clearly, away from the pressures and panic of market trends. He began to build his own investment partnerships, raising money from family and close friends. He didn't promise fast returns or dramatic gains. He simply offered a disciplined approach and honest communication, and people trusted him. His early partners included doctors, teachers, neighbors, people who believed in Warren's calm, methodical way of investing. As the partnerships grew, Warren remained grounded. He never drove luxury cars or moved to expensive cities. He studied every company he considered investing in as if he were going to own the entire thing. He read thousands of pages of annual reports, not because he had to, but because he wanted to understand every detail. He looked for businesses with durable advantages, companies that had strong brands, loyal customers, and simple operations. His goal was not just to buy low and sell high. His goal was to find great companies at fair prices and hold on to them for the long term. He once said that his favorite holding period was forever. Warren's time under Benjamin Graham helped shape his intellectual framework. It taught him how to avoid mistakes, how to spot value, and how to remain calm when others panicked. But just as important, it gave him the confidence to trust his own instincts. He learned that great ideas come from deep thinking, not from following the crowd. That real wisdom is quiet and patient, and that the best investments are often the ones other people overlook. Warren Buffett was no longer just a gifted young investor. He was becoming something more, a man who would change the way the world thought about money, risk, and opportunity. How do you build a financial empire without chasing headlines, without flashy trades, and without living in the spotlight of Wall Street? Warren Buffett did exactly that, and it all started with a small partnership and a big vision. After returning to Omaha, Warren launched Buffett Partnership Limited. In 1956, he started with just over $100,000 collected from family and friends. He rented a small office and began managing the fund with the same methods he had learned from Benjamin Graham. But this time, he also trusted his own growing instincts about business quality and long-term value. Warren didn't look for the next big thing. He looked for companies with solid fundamentals, trustworthy leadership, and products or services that people truly needed. He would spend hours, sometimes days, reading a single company's financial statements. He didn't rely on stock tips or market rumors. Instead, he trusted hard data and sound judgment. His partners didn't hear from him every day, but they didn't need to. He sent out detailed annual letters explaining how the partnership performed, what he had bought, and why. These letters became legendary, not for their excitement, but for their clarity. Warren believed in transparency. He believed that if people trusted him with their money, they deserved to understand how it was being used. His goal was simple: beat the market, but do it without taking unnecessary risks. And for more than a decade, that's exactly what he did. While other investors chased hot trends, Warren quietly bought undervalued stocks. He often went against the crowd. He didn't panic when the market dropped. He saw those moments as chances to buy good businesses at bargain prices. By the mid-1960s, Buffett Partnership Limited had grown substantially. Warren's reputation for wisdom, patience, and performance began to spread. But Warren wasn't just interested in stocks. He was interested in businesses, real operating companies. That's when he came across a struggling textile company called Berkshire Hathaway. At first, it was just another value play, a cheap stock with a tangible asset base. He bought shares slowly and watched the management. But as time passed, he bought more and more until he eventually gained control. Most investors would have shut the factory and taken the money. But Warren did something different. He used Berkshire Hathaway as a vehicle to buy other businesses. It became his holding company. Slowly, he transformed it from a failing textile mill into one of the most valuable corporations in the world. Through Berkshire, he bought companies like See's Candies, a beloved regional chocolate brand with loyal customers and strong profits. He invested in insurance firms like GEICO, which provided steady cash flow and long-term growth potential. Over time, he added railroads, furniture stores, newspaper publishers, and eventually some of the biggest names in American business. But it wasn't just what he bought, it was how he bought it. Warren didn't interfere with the day-to-day operations of the companies he acquired. He looked for strong managers, trusted them to do their jobs, and let them operate independently. He wasn't interested in micromanaging. He was interested in alignment. As long as the company made money honestly and kept growing steadily, Warren was happy. He gave his CEOs freedom, and in return, he earned their loyalty. This approach created a culture of trust and performance across the Berkshire network. It also allowed Warren to focus on what he did best: capital allocation. He didn't try to run railroads or make candy. He focused on where to put the profits so they could grow even more. Buffett's genius wasn't in invention, it was in evaluation. He was a master at figuring out what a business was truly worth, what kind of cash it could produce, and how likely it was to survive hard times. He didn't chase perfect numbers. He looked for consistent results. He famously avoided tech stocks in the early days because he didn't understand them well enough. That was Buffett's rule: only invest in what you truly understand. If he couldn't explain a company in a few simple sentences, he didn't buy it. This discipline protected him from massive losses, even when other investors made headlines. While others were swinging for home runs, Buffett was hitting steady singles and doubles. The strategy worked. Year after year, Berkshire Hathaway's value increased. Warren's net worth rose with it, but he didn't change his lifestyle. He still lived in the same Omaha house he had bought decades earlier. He still drove himself to work. He still read for hours each day, studying companies, trends, and opportunities. His life didn't become more complicated, it became more focused. He said no to hundreds of deals for everyone he said yes to. He passed on trends that didn't match his criteria, and he didn't care what others thought about it. Buffett once said, "You don't have to swing at every pitch, wait for the right one." That mindset helped him avoid hype-driven bubbles and devastating crashes. Buffett Partnership Limited was eventually dissolved in the late 1960s, but by that time, Warren had already moved most of his energy into Berkshire Hathaway. It became his main platform for investments. As the decades passed, Buffett continued to build. Not with speed, but with care. Not with noise, but with certainty. He proved that you could become a billionaire by being thoughtful, honest, and long-term minded. His empire wasn't built in skyscrapers or trading rooms. It was built in quiet offices, in simple meetings, in long hours of reading, and in decisions made with clarity. Warren Buffett didn't rush. He didn't gamble. He built something that would last. What makes a man worth billions choose to live like someone worth far less? In a world obsessed with luxury, Warren Buffett's simplicity stands out almost as much as his success. Despite being one of the wealthiest individuals on the planet, Buffett never sought the extravagant lifestyle that often comes with financial power. He still lives in the same modest home in Omaha that he purchased in 1958 for $31,500. It's not a mansion, and it doesn't have a private helipad or an ocean view. But for Buffett, it has everything he needs: a comfortable space, familiar surroundings, and no distractions. He drives himself to work, often in an ordinary car, and prefers fast food over gourmet dining. McDonald's breakfasts, cherry Coke, and simple routines are part of his daily life. To outsiders, this may seem strange, but to Buffett, it's just practical. He once explained that living modestly allows him to focus on what really matters. Instead of worrying about luxury, he dedicates his mental energy to reading, thinking, and making investment decisions. In fact, he spends nearly 80% of his day reading books, financial reports, newspapers. He believes that accumulating knowledge over time is one of the key ingredients of his success. He doesn't believe in multitasking or rushing. He prefers deep focus. While most CEOs fill their calendars with meetings, Buffett guards his time. His schedule is famously light with few appointments. This gives him space to think clearly and act deliberately. Buffett's lifestyle reflects a larger philosophy that has shaped his entire career. He values clarity over complexity, substance over style, and results over appearances. This same approach defines how he chooses people to work with. One of the most important relationships in his life is his partnership with Charlie Munger. Munger, a lawyer-turned-investor, shares Buffett's values but adds his own perspective. Where Buffett was once deeply focused on price and safety, Munger introduced the idea of quality. He encouraged Buffett to look not just for cheap stocks, but for excellent businesses at fair prices. This shift changed everything. The two men became intellectual partners, challenging each other, sharing ideas, and refining their strategies. They didn't always agree, but they respected each other's thinking. Their collaboration brought more wisdom and balance to Berkshire Hathaway. Together, they created an environment where decisions were made slowly, thoughtfully, and with conviction. They believed that you didn't need dozens of great investments. You just needed a few outstanding ones. And you needed the discipline to wait for them. Over time, Buffett's personal image became as legendary as his investment record. He was the billionaire who didn't act like a billionaire, the executive who preferred quiet honesty over corporate spin. He rarely sought the spotlight, but his wisdom brought it to him anyway. Each year, thousands of people would travel to Omaha for the Berkshire Hathaway annual meeting, often called Woodstock for capitalists. They came not just for financial updates, but to hear Buffett and Munger speak. Their talks were filled with insights, jokes, life advice, and plain-spoken truth. Buffett never pretended to be something he wasn't. He admitted his mistakes, explained his decisions, and gave credit where it was due. He didn't build a brand. He became one by being consistent. His ethical approach set a tone for how he ran his companies. Buffett didn't just want profits. He wanted companies that treated people well, played fair, and delivered real value. He avoided businesses that relied on deception or speculation. He once said, "It takes 20 years to build a reputation and 5 minutes to ruin it." This sense of responsibility guided not only his investments, but also his public statements. He spoke out about issues like corporate governance, tax fairness, and financial transparency. He believed that wealth came with the duty to be honest and generous, and he lived those values. When asked why he hadn't moved to New York or Silicon Valley, Buffett said he preferred Omaha's slower pace. Being away from the frenzy helped him stay focused and independent. In Omaha, he could think deeply without distractions. He didn't follow the trends of the financial world. He stayed true to his own principles. This independence made it easier to make hard decisions. He didn't have to answer to short-term pressures or quarterly expectations. He built Berkshire Hathaway with long-term thinking at its core. This mindset made Buffett not just a great investor, but a wise steward of capital. He once said, "Our favorite holding period is forever," and he meant it. He wasn't in the business of flipping assets. He was in the business of building value. Even his personal habits reflected this. He avoided debt, lived well within his means, and encouraged others to do the same. He viewed money not as a trophy, but as a tool, something to be managed with care and used to create meaningful results. This attitude helped him maintain perspective, even as his wealth soared into the billions. He didn't see himself as better than anyone else. He valued humility and common sense over image and influence. To Buffett, what mattered wasn't how much you had, but how wisely you used it. His example taught millions that wealth isn't just measured in dollars. It's measured in discipline, integrity, and how you treat others. Warren Buffett's lifestyle wasn't just a personal choice. It was a philosophy in action, a daily reminder that success doesn't require excess, and that living simply can be a form of strength. How does a soft-spoken man from Nebraska become one of the most respected voices in global finance? Warren Buffett's rise to the status of the Oracle of Omaha didn't come from loud predictions or flashy wins. It came from decades of quiet consistency and remarkable insight. By the 1980s and 90s, Buffett was no longer just a successful investor. He was a household name in the world of finance. His annual letters to shareholders were widely read not just for financial updates, but for life advice, business wisdom, and reflections on human nature. His investment portfolio was also becoming a study in long-term brilliance. Buffett had begun placing bets on iconic companies, not for short-term gains, but for their ability to generate stable, growing earnings over decades. He purchased large stakes in Coca-Cola, American Express, and Gillette, companies with strong brands, loyal customers, and products that people continued to use regardless of economic conditions. These weren't risky ventures. They were businesses that had proven their resilience and were likely to endure. Buffett's investment in Coca-Cola, for example, became legendary. He invested over $1 in the late 1980s and held on to it for decades. He didn't just look at numbers, he looked at behavior. People around the world drank Coca-Cola daily. That kind of brand power, Buffett believed, was almost impossible to replicate. He was often asked why he stayed away from certain sectors, especially during the dot-com boom. While many investors rushed into tech companies with little or no earnings, Buffett stayed out. He famously said, "I don't invest in what I don't understand." This philosophy protected him when the bubble burst in the early 2000s. While others lost billions, Buffett and Berkshire Hathaway remained strong. Buffett also became known for his calm presence during crises. When the 2008 financial collapse shook global markets, he didn't run for the exits. Instead, he made strategic moves. He invested in companies like Goldman Sachs and Bank of America, providing them with capital when few others were willing. His vote of confidence helped stabilize markets and earned him respect not just as a businessman, but as a leader. He was praised for his steadiness and clear thinking in moments of panic. It wasn't about being bold, it was about being wise. Buffett's influence extended far beyond investing. He became a public educator of sorts, regularly speaking to students, writing essays, and appearing in interviews to explain complex financial ideas in simple terms. He warned against greed, advised people to avoid debt, and encouraged saving and investing with patience. He often joked that his favorite holding period was forever, but behind the humor was a deep truth. Real wealth takes time to build. Buffett's reputation for honesty and humility only grew. He was admired not just for how much money he made, but for how he carried himself while doing it. He rarely spoke about politics, but when he did, he emphasized fairness and responsibility. He advocated for higher taxes on the wealthy, including himself. He believed that success in a capitalist society came with moral obligations. He urged leaders to consider the impact of their decisions on ordinary people, and he led by example. Under his leadership, Berkshire Hathaway became a symbol of reliability. Its shareholders' meetings, held annually in Omaha, began drawing tens of thousands of attendees from around the world. People came to hear Buffett and Charlie Munger share insights, field questions, and reflect on their decades of experience. The meetings weren't just business events, they became cultural gatherings, part entertainment, part education, and entirely authentic. Buffett's ability to connect with people came from his clarity. He avoided jargon, never tried to sound smarter than others, and told stories that made ideas memorable. Whether he was explaining why a company mattered or how to think about risk, he used language that anyone could understand. That clarity made his ideas stick. His quotes were repeated in classrooms, boardrooms, and books. Be fearful when others are greedy, and greedy when others are fearful. It's better to buy a wonderful company at a fair price than a fair company at a wonderful price. And of course, the stock market is a device for transferring money from the impatient to the patient. These weren't just clever phrases. They were reflections of a lifetime of disciplined thinking. Over time, Buffett's name became synonymous with integrity in business. He wasn't perfect, and he admitted when he made mistakes. But he never blamed others. He owned his decisions. When something went wrong at one of Berkshire's companies, he took responsibility. This accountability made him stand out in a world where excuses are often easier than honesty. His legacy as a business leader is about more than results. It's about character. In an era filled with shortcuts and hype, Buffett built something lasting by doing the opposite. He chose consistency over trends, patience over speed, and truth over image. He proved that it was possible to win without cutting corners, and that trust, once earned, could become a competitive advantage. Warren Buffett didn't just build wealth, he built belief. Not just in stocks, but in the idea that doing things the right way still mattered. What does a man who has everything leave behind when he's gone? For Warren Buffett, the answer has nothing to do with yachts or private islands, and everything to do with purpose. As Buffett entered the later stages of his career, he began to focus more openly on what would remain after him. His decisions, long grounded in wisdom and discipline, began to reflect an even deeper sense of responsibility. He didn't just want to build wealth, he wanted to ensure it could be used for good. In 2006, Buffett made a historic announcement. He pledged to give away the vast majority of his fortune, beginning with a major donation to the Bill and Melinda Gates Foundation. It was the largest philanthropic donation in history at the time, and it stunned the financial world. But for Buffett, the reasoning was simple. He believed that money could only serve its highest purpose when it was helping others. And he trusted that the Gates Foundation, with its global reach and focused leadership, could turn his billions into vaccines, schools, clean water, and opportunity. But he didn't stop there. Buffett joined forces with Bill and Melinda Gates to create the Giving Pledge, a commitment by the world's wealthiest individuals to give away at least half their fortunes during their lifetimes or in their wills. The idea was powerful, that wealth, when paired with purpose, could become a force for lasting change. Dozens of billionaires signed on, inspired by Buffett's example. Some had never considered large-scale giving until he showed them a new path. His philosophy on inheritance was equally surprising. Buffett has said for years that he plans to leave his children enough money so that they would feel they could do anything, but not so much that they could do nothing. He believed that too much inherited wealth could limit rather than empower. Instead, he raised his children with strong values and encouraged them to find their own paths. Buffett's legacy isn't just financial, it's intellectual and moral. He spent decades mentoring young people, sharing his thinking, and encouraging others to live with intention. He often speaks at universities and spends hours answering questions from students. He gives advice not just about investing, but about how to live. He talks about integrity, patience, humility, and the importance of choosing the right life partner. He reminds people that time is their most valuable asset, and that reputation takes years to build but moments to lose. His humility makes these lessons stick. He jokes about his diet, his love for bridge, and his lifelong friendship with Charlie Munger, but beneath the humor is deep insight. Buffett knows that life isn't measured only in financial statements. It's measured in relationships, choices, and the legacy you leave behind. He often says that the real test of a person's success is whether the people they want to love them actually do. That test has nothing to do with net worth. Buffett's approach to life and business has influenced millions. Books, documentaries, and articles have captured his methods, but more important than any formula is his way of thinking. He taught us that you don't need to be first, you need to be right. That you don't need to be flashy, you need to be wise, and that success without values isn't success at all. As he grows older, Buffett remains active. He still writes, speaks, and manages investments. He still arrives at the office with a McDonald's breakfast and a stack of newspapers. But he's also made plans for what happens next. He has outlined a clear succession plan for Berkshire Hathaway, ensuring the company will continue under leaders who share his values. He's laid out how his remaining wealth will be distributed for charitable causes. And he's continued to encourage others in positions of influence to think bigger than themselves. Buffett's story is a rare one. It's not about one lucky break or a series of fortunate events. It's about a life of intention, of reading, learning, thinking, and acting with care. It's about building not just a portfolio, but a philosophy, not just creating value, but sharing it, and not just being smart, but being wise. Warren Buffett's legacy is already taking shape, not in monuments or lavish gifts, but in changed lives, inspired minds, and a more thoughtful generation of leaders. He may be known as the world's greatest investor, but his greatest investment may be the example he leaves behind. What can we truly learn from the life of Warren Buffett? Not just how to invest, but how to think, how to choose, and how to live with purpose. His story isn't just about numbers. It's about values, consistency, and the power of clear decisions made over a lifetime. From selling chewing gum door to door as a child to becoming one of the most respected investors in history, Buffett's journey shows what's possible when passion meets discipline. He didn't chase fast money or try to impress others. He followed his own path step by step. He taught us that you don't need to be in a big city to make a big impact. You don't need luxury to be successful. You need patience, honesty, curiosity, and the courage to stay true to what you believe. His success wasn't built on secrets. It was built on timeless principles: buy what you understand, think long-term, avoid debt, read constantly, and above all, protect your integrity. Buffett reminds us that wealth is not the goal, freedom is. And freedom comes from wise choices made over and over again. As we look back on his life, we're not just inspired by his fortune. We're inspired by his character. If Warren Buffett's story taught you something today, think about how you can apply it to your own life. Whether it's saving more, learning more, or simply living more honestly, every small change matters. Thank you for listening to this story. If you enjoyed it and want more inspiring true stories told in clear, simple English, don't forget to subscribe to the channel. Leave a comment below. What lesson from Warren Buffett's life stood out the most to you? Until next time, keep learning, keep growing, and remember, the best investment you can ever make is in yourself.